Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is August 14th, and I'm recording this from Buenos Aires, where I'm still on my South America tour. But I'm delighted to be joined here by Dr. David Kelly, Chief Global Strategist of JP Morgan Asset Management. Welcome, David. Great to see you here.
Very glad to be here, Ethan. Happy to do
Uh,
this.
And we have a lot to get through. It's never a dull moment in the state of markets. So we'll just pull up my usual slides and we'll kick that off. Well, I have called this Notes from a Laboratory, and that's only relating to my current location, as Buenos Aires and Argentina's economy in general has been described as a laboratory for economic policy. We will not be talking specifically about Argentina today, but we could say that we are all in a laboratory of sorts, as much economic policy is being tested and retested in real time. So I think that's the relevance of that analogy. We have David's bio here, Chief Global Strategist and Head of Global Markets Insight Strategy Team at JP Morgan Asset Management. And as usual, we're going to cycle through the topics we always cycle through of inflation, interest rates, equity markets, geopolitics, and other factors such as the strength of the dollar that might impact your portfolio. And we're going to kick this off with inflation. We've had some inflation news this week. We've also had the impact that may have on the Fed's propensity to lower rates. We've had interesting developments in markets, which I've deemed a split screen, as we've seen equity markets get very strong on the one hand, but yet some sectors really lag, some evincing some weakness of the consumer. And we'll ask whether geopolitics does matter to markets these days, as it still continues to rage, but markets seem to move a little unmoved. So, David, just kick this off with inflation. I'd love to hear your insights. We have had some inflation news this week. Some have taken this news as meaning that we will now be off to the races with interest rate cuts. They've been reassured by the inflation news. Others are suggesting that perhaps this has all been driven by weak oil, weak food, and that actually services and labor are not as low as where they should be. What is your current insight and reading of the way inflation is moving in the US anyway?
Well, overall, we do think that inflation is going to move higher. I think the issue here is purely lags in terms of how long it takes for tariffs to feed through to through the system. We got some relatively very much in line with expectations numbers, honestly, on overall inflation, 2.7% year over year on CPI, but 3.1% year over year on the core CPI. We're going to get numbers later on this month on what that means for consumption deflator inflation, but we're sort of in the mid twos there. But what's going to happen is we're just seeing the early innings of how these tariffs will affect inflation. I mean, the first thing is we can see the tariff revenue, but the tariff revenue so far is not in line with the actual rates that the government is charging in terms of import taxes. And what that tells us is a lot of the stuff was shipped in before the tariff, was shipped out of other countries before the tariff rates took hold, and so we're still seeing a bit of a lag there. And even when the stuff arrives here and the tariff taxes are paid, then it has to be distributed around the country. It takes a while to get it out of warehouses and onto trucks and onto shelves. And at that point, then you will see retailers, I believe, mark up prices on this new inventory, and then you'll see the full effect. But we think that it is lagged. We think we're modeling about a 3 month gap between when the tariff rate changes and when we actually have that impact in terms of beginning to hit CPI. And then we think it'll hit CPI over about a 2 or 3 month period beyond that. So bottom line is we think that overall inflation right now, 2.7% year over year, is going to go into the high threes by the end of this year, by the fourth quarter, and certainly into December and January of next year. And then I think it's going to be sustained for a little while because of a lot of fiscal stimulus. And I think we can talk a bit about that. I think you're going to have a huge income tax refund season early next year, which is going to act like a stimulus check. And then eventually it's going to come back down again. So I think it's a low grade fever, but it's going to hang around for a while here. And it's only in the back half of 2026 that I think you'll see inflation begin to once again approach the Fed's 2% target. So I think the worst is yet to come in terms of inflation.
And it's interesting. I would agree with you on that transmission effect. Certainly, it's far too early to say whether tariffs have had an effect on inflation. One narrative that's circulating a little bit is this notion of eating the tariffs, that not only will some of the domestic providers who are affected on the cost side be forced to eat the tariffs, and I think Walmart was suggested they should do that, but also that some of the Chinese Exporters will also eat the tariffs because they are at such overcapacity. Do you have a sense that anyone has the capacity or the wiggle room to eat much in the way of tariffs and avoid passing them on?
I don't see why they should. I mean, I think that generally speaking, you've got either those organizations who have been very good at putting costs onto consumers in the past, or you've got those organizations which operate on such a tight margin they really don't have that capacity. But first of all, on foreign producers, if we were going to see foreign producers eat the cost, you would see import prices fall because import prices are calculated before the tariffs are paid. And so what we've seen so far is if you look at non-fuel import prices, we haven't seen any decline. We haven't actually seen much of an increase. So it's clear that foreign producers aren't being very aggressive in marking prices up, excluding the tariffs, but it doesn't look like they're eating the cost. And also, you know, people say this, but yeah, I mean, Walmart had to write the check. Okay, so the person who writes the check is the importer, which in this case might be Walmart or Home Depot or wherever. They have to write the check, so of course it looks like it's on their shoulders. And they will, you know, look you in the face and say, "Oh, we're not going to pass on to consumers. Oh no, no way, our price is going to go up. Let's see what happens." Because my guess is they do pass it on to consumers. All the research that I've seen in terms of historical precedent, and there isn't much historical precedent from tariffs of this magnitude, suggests that ultimately the consumer has to get hit by it. And I think that's what will happen. It's just going to take a little while.
And of course, the other things affecting consumers is an area here. Some areas, some things are more affected by tariffs than others. We've seen furnishing supplies very levered to China. Clearly, new cars ticking upwards. Apparel seems to have come down somewhat. And one of the areas, of course, is the oil price that is very visceral for the US consumer as they pay the price at the pump on a regular basis. Seems that oversupply there perhaps is keeping that price low. Maybe even depressed economic activity is keeping that price low. That could be the counterbalance, I suppose, to these other inflationary forces. Any sense as to whether this is a long-term trend here on the oil price?
Well, I'm glad you put the question that way because that's exactly the issue. You know, the biggest indicator that energy prices are going to fall is when they're too high, and the biggest indicator that they're going to rise is when they're too low. And you've got a chart here looking in, I presume this is in nominal terms in terms of oil prices, but actually, if you look at it relative to inflation, these oil prices in the low 60s are extremely low. And they're low relative to the cost of production for US producers, low relative to the cost of production for many producers around the world. If you look at the global economy, the latest global PMI data that we've seen looking across both manufacturing and services, it's not that weak. It's not that strong either. It's just, you know, the global economy is just chugging along. But there isn't some collapse in demand. What we are seeing, and it's kind of interesting, is that perhaps because you know, the administration has got some very close relationships with some of the leadership in the Gulf, it may be that OPEC is right now being much more willing to pump more oil at the behest of the U.S. administration than would normally be the case. That's only going to last for a little while. I mean, if the price is too low, it's going to go up. And when I see prices this low, I don't expect an immediate increase. But if I had to put a bet on the table, I'd say that a year from now, oil prices will be substantially higher than they are right now. And so it'll add to inflation in the second half of 2026. So just when you get over the tariff inflation and the stimulus inflation, you get some oil inflation. And you know, all of this, it's one of the reasons why, you know, I think it's going to take a little while to get inflation down to that 2% number.
And this is, of course, this lower oil price perhaps is masking the kind of persistent and resilience of the service price inflation, which is a big part of that. And I think with the other part that we also in this section look a little bit about the sort of vibe check in terms of the economy, in terms of where we are on the kind of hard landing, soft landing scenario. And I'd say that it's interesting that despite the revision of the employment numbers, there seems to be an almost elimination of the term hard landing. And there seems to be a sense that we have now executed this soft landing, but yet it's still a sense that markets are overvalued. Where do you think on the recession forecasting we are able to kind of safely say that we're past that, or do you see kind of trouble afoot?
Well, oddly enough, I agree with both sides of that argument because I don't think they actually disagree with each other. First of all, this is a tortoise of an economy. and it is getting to be a rather an older tortoise too. I mean, it was growing so far this century. The economy's grown by 2.1% per year on average in real terms. That's not great relative to history, but we think that particularly because of some labor supply issues, it may grow by less than that going forward, maybe in the order of 1.7 or 1.8%. So we think it's a slow growing economy anyway. And we have seen slowdown in payroll job growth, yeah, but we're also seeing a slowdown in the supply of labor. And so we don't expect to see the unemployment rate go up much. We think that it's quite possible that the economy moves forward at, I think actually this year all total it'll probably grow by no more than 1%, probably less than 1%. But that could still be consistent with an unemployment rate below 4.5% or at 4.5% by the end of the year. So we think we'll avoid recession. It's just a pretty slow growing economy, and you should expect to see slower job growth out of a slow growing economy. And I think that's where we are. But it is a sort of resilient, steady tortoise. I can't see anything big enough to put us in recession right now. There's no big shock that's likely to put us in recession. So I think we'll just trudge forward at a slow pace.
I love that term, the slow, resilient tortoise. I heard somebody, there was a citing from someone from T.S. Lombard this week who said we're in a low hiring, low firing equilibrium, which sounds just a bit as just about quite as slow as that tortoise, and suggesting that the revision, the jobs numbers, wasn't really that bad. It got a lot of attention, especially with the subsequent removal of the head of statistics, but it really wasn't that bad. There was a lot of reaction to these jobs numbers being revised, suggesting that that was now going to point us towards even a double Fed cut. And just moving to the topic of rates and this resilient economy, is this the time to be cutting rates, by 50 basis points? Do you think the Fed is finally going to be moved by the tremendous pressure, or will it remain data dependent?
Well, I'll answer that, or I'll try and address that. But I do want to mention that at some stage I want to talk about the hare of the market that has been outpacing this tortoise of an economy, because I think that's where a lot of the interesting part of this investing environment is. But getting back to the Fed, I think the Fed probably will cut rates, but honestly, they shouldn't. If I'm right and the economy is avoiding recession, and if at the end of the year we're at over 3% of the consumption deflator, we're about 4.5% on the unemployment rate. I mean, let's think about what the Fed thinks in the long run. In the long run, they think that 4.2% is full employment. If we're at 4.5, we're essentially there. In the long run, they want to get to a consumption deflation inflation rate of 2%, 2.0%. We think they'll be over 3%. So they're going to be further from their inflation target than their unemployment target by the end of the year. So that's one thing that I would say you shouldn't ease. And then they may argue, and some will argue, well, yeah, but monetary policy is restrictive. Well, why do they say that? I mean, I know that they penciled in that in the long run they think the federal funds rate ought to be 3%, but I don't know why they're saying that. What I will tell you, and I'm sure you know this, Stephen, is that in the 50 years before the financial crisis, the federal funds rate averaged 1.8 percentage points above core CPI inflation. The latest print on core CPI inflation is 3.1%. You add on 1.8 to that, you end up with 4.9. So the federal funds rate is now 4.25, 4.5. That would say that monetary policy is easy. Moreover, if you look at the bubbly stock market and bubbly home prices, I would argue that that monetary policy is easy. So I don't think that it's that the Federal Reserve is being particularly tight here and needs to cut rates. I don't see anything in the short-term outlook which says they should. But I think political pressure is going to cause them to cut rates. I don't think they'll cut twice. I think they'll cut 25 basis points in September because they know they're doing the wrong thing. So I think they'll do it in small doses. But I think they will probably cut in September and cut in December also, because they're not going to be able to stand the heat coming from the other side of Washington.
It's so interesting that would completely align with the caution, I think, is sprinkled by Austin Goolsbee around not getting too carried away, because markets did, these commentators jumped to a conclusion that perhaps two rate cuts were in the running. I'd love to now get back to, I don't want to leave the hare out of this discussion. We spoke about the tortoise and the hare, and I suppose to bring that analogy one further, is this a single hare? We talk about the market, or are we talking about a series of hares, some of which are doing better than others?
Well, it reminds me a little bit of a few weeks ago. I was out in Western Massachusetts with my older son Andrew, who's a very good runner. I know you like running and I like running, but he's a lot faster than either of us. And so we went out for a run. And so I was running down so in Western Massachusetts, it's very hilly. So when we ran down 2.5 miles, had a very nice conversation. And then the louse started bouncing up the hills in front of me on the way back up. I mean, I would have thought he'd have more respect for his venerable parent, but it was quite clear who the tortoise and the hare were in that scenario. But the question I was asking myself as I was trundling back up the hill in the heat was, well, is the tortoise going to catch the hare? Is the hare going to come back to the tortoise? And I think this is really the question that investors need to ask themselves. How long can you have markets provide these spectacular returns in an economy that's really not doing that much? I mean, I know the profit margins are pretty good, but I do think that there is sort of asset bubbles have been growing all over the place. I think mega cap US equities are still too expensive. I get it that all of these companies are very successful, but I still think those prices are pretty high. I think home prices are too high. I think if even I think international equities look okay, but a lot of the S&P 500 itself, even outside of the mega caps, doesn't look particularly cheap. So I do think that asset markets have moved too far ahead, given the amount of risk that there is in the environment. I think people need to be careful here.
And I mentioned multiple hairs because I think what we've spoken about a few times has been this concentration of markets. And even since the last time we spoke, this concentration has grown exponentially. And I think, the race, the AI race, if we're speaking in analogies, that clearly is an arms race that's continuing to get a lot of attention. But if we look at some other sectors in the economy sectors that have done well would include clearly financials have picked up some steam as well with the deregulatory tailwind. But other sectors, say, looking at, say, fast casual chains of eating, that's done very badly this past week. I've never been one for the expensive salad bowls, but it seems like a few people are any longer. And similarly, weight loss pills having had a lot kind of baked into the price there, even when Eli Lilly came out with a pill as opposed to an injectable. They didn't meet expectations, so they took a tumble. So it's clearly not every hair is having its greatest race. How do you think about the market, this dispersion we're seeing?
Well, I think a lot of it has to do with consumers, because the great mass of consumers, if we're counting by heads, aren't doing that well. We've got, we don't lower and middle income households aren't doing particularly well. They're not benefiting from these huge stock market gains, and so anything that depends upon the spending of the masses is going to be in some trouble here. I think for example, the tourism industry is in some trouble here. I think food restaurants are getting hit on both sides because the great mass of the public doesn't necessarily have the money to spend on restaurant meals, but also they can't find the staff to staff the kitchen, which is another issue. But in general, things that depend upon the mass spending of American consumers are in some trouble. Things that can be latched onto the AI theme or technology theme or stuff that is servicing the richest households in America are doing well. And I think that's true. I think it's true actually around the world, not just here in the United States.
Interesting. So if you're a sector that's exposed to the consumer demand, or you're a sector exposed to, say, import tariffs, clearly that would be a double whammy. And then something like the large tech stocks are probably immune to both of those, at least for the moment. Do you see that as a problem in terms of investors' ability to gain exposure, and that the markets have become just so concentrated? Do you think that will bring in more volatility? And another chart I had shown here was just how low volatility is. We used to consider low vol to go with a low growth, low interest rate environment that we had in the past. Now we've a high rates, but still somewhat low growth and low vol. Is this a market that is easy to navigate for investors?
Not really. I mean, I think there's this disconnect between fundamentals and the way the market's behaving. I think that disconnect has been growing. I think with the growth of passive funds and both the index funds and ETFs, but particularly anything that's passive or anything that is sort of run out of algorithms as opposed to fundamental analysis, is giving a bias to the market in terms of people are sort of blindly putting money into it, and it's reducing volatility. So I think that makes it. I think that gives you a false sense of comfort. What we know about stock market returns is they are not what you would call statistically normally distributed at all. Everything is very calm. It looks, it's like it's kind of, I'm trying to think of a good analogy. It's kind of like a runway model with clown shoes. It's very thin. Most of the distribution is very thin for the most part. But then it's surprisingly wide at the at the extremes, and so we can get some shock here. Say if the narrative changes, you get a significant shock, which people don't really think about. But I can sort of understand why volatility is low because people are just sort of blindly, okay, this fund's doing well, we're going to put some more money into it without thinking about the fundamentals and fundamental financial ratios and fundamentals of the economy or even fundamental risks. So I think that there is some problem there. And I think that investors, it's not a matter just of accessing these returns. A lot of people have made a great deal of money in recent years by just being passively in the market. But I think people need to be broadly diversified and recognize there is risk, even if you can't see it in things like volatility.
Yeah, absolutely. And I think we've spoken before about what could it be that would be that shock. It seems that markets are now more immune to geopolitics, and there's a slide later I can show showing how geopolitical news does not seem to sway markets at this stage. Equally, tariff news, even the tariff uncertainty, seems to have subsided. And it does seem that flows themselves, simply that weight of money on the sidelines in money market funds or wherever, that race for yield and race for growth seems to have overwhelmed tariff uncertainty. I mean, do you see that that is still brewing in the background? We're just not as focused on it, or has that generally kind of worked its way through?
No, I think what you say is true. First of all, I do think the tariff uncertainty has come down a bit, and I think that to some extent geopolitical uncertainty has come down a bit. I mean, the horrible mess in the Middle East is seems less likely to lead to macroeconomic consequences for the world. You've got this horrible situation in Ukraine still, but again, those risks haven't gone up. We know more about the tariffs now than we knew in early April. So I think and we know more about tax policy because of the passage of the OBBBA. So I think we have had a reduction in some areas of uncertainty and geopolitics, but there's still things that get us. I mean, it's I think the message from the 21st century so far is the thing that you got to worry about is the thing that you couldn't imagine happening. So I still worry about things like cyber attacks. I mean, it's we have we had a biological virus. What if we have a technological virus which becomes particularly difficult to actually deal with, and so begins to have it manifests itself across all sorts of types of technology. We're very vulnerable to something really bad happening there, or we've got a lot of elderly leaders of autocratic regimes around the world who've got lots of potential to cause trouble. So sooner or later, something's going to happen that's going to rattle people's belief in the stability of the system itself. And when that happens, we'll have a bear market. We just don't know when that's going to occur.
And I've always remembered your adage that diversification is not for what you think will happen, is for what you cannot anticipate to happen. And that is exactly the very reason why we diversify. And I suppose my kind of ending theme is just around portfolio construction at this time. I have one chart here showing flows, and this is about rotation, bit of a rotation in August into emerging markets, global equities, utilities, out of healthcare, out of the beleaguered Eurozone, who can't seem to catch a break for very long, and investor sentiments, it seems, out of real estate. This could be an episodic thing just for the month of August, but it does seem that with American exceptionalism returning to the fore, that increasingly some of these peripheral markets are falling away, at least in terms of investor attention, and they're certainly falling away in terms of relative size. So, how do you diversify a portfolio? Do the same rules still apply?
No, I think the rules are changing over time. I think, one of the things that sort of strikes me about investors is investors get bored very easily. So they're either sitting in cash, and that's basically because they're interested in how the world's going to destroy itself, or they're trying to find, well, what's the biggest beta bet I can make? So I'm not surprised to see money piling into EM as opposed to Europe. I actually think Europe is probably, for the most part, a better long-term bet. But people are, piling in. I get that. But I would say just in general, think a little bit about these tariffs and this inflation, the idea of American exceptionalism. I'm not knocking American exceptionalism. I mean, you and I are both from Ireland. We both live in the United States, and we both have a great deal of confidence in the way the U.S. economy will behave in the long run. But people are paying a lot for that exceptionalism right now. And to me, first of all, I would diversify around the world. I still think the dollar is too high. If the Fed does capitulate, even if they shouldn't capitulate, that may push the dollar down some more and enhance the return on European investments. I mean, even with the flows going the wrong way in August, eurozone stocks in US dollar terms are up in the high 20s year to date in terms of total return. So it has not been a bad year at all. It's been a very good year for European equity exposure. But the other thing is we believe in alternatives, things like infrastructure, real estate, global transportation, ways of just adding some extra stability to a portfolio. So I'm kind of an omnivore when it comes to investing. I want to have everything on the plate. And I think a lot of people aren't that way. I think a lot of people are either just all in on US tech stocks or sitting in cash. I think they really need to diversify. As you pointed out, is the reason you diversify is not because of what you expect, but because of what you don't expect. And the thing about what you don't expect is you don't know what direction it's coming from, and so that's why you diversify rather than just try to hedge against a particular risk.
Well, that's me bringing your own words back to you. So that is your wisdom. I certainly don't want to take credit for that. But that's very interesting. I think getting back some of these sectors you mentioned do remind me of the kind of tortoise sectors, say the infrastructure, the kind of steady state income, the inflation protection, real estate certainly has been chugging along, and when it hasn't crashed in that kind of manner. And I suppose lastly, just small cap, mid cap. I mean, has anything structurally changed there, given the absolute dominance that we're seeing of large cap? And we hear a lot about excitement around IPOs, but on the other hand, it does seem to be for a select few tech IPOs that we're seeing that kind of a new lease of life. It's not maybe for small and the mid cap. And these are maybe the forgotten segments that are being deeply affected by tariffs and by the consumer's frailty. Do you still see that kind of idea of a balanced portfolio across the cap spectrum as making sense?
Well, yes, to some extent. I mean, I'll admit what you said about you. I mean, I do think Europe has kind of got a bit of a break this year, but small caps haven't, and I think they're getting caught in a lot of different directions. One of them is the growth in private equity, which is snapping up a lot of the great ideas that might have dominated small caps in the past. Another is that people tend to get into small caps after you've had a cyclical downturn, but if this tortoise doesn't roll over and fall into recession, then you don't have that cyclical downturn, so it never seems like quite the right time. You have a lot of companies in the small cap indices that are actually making no money. They're making losses. That's not good. And as you said, they are vulnerable to tariffs to the extent that they are importers of stuff. And particularly if they're facing low and middle income consumers. So there are plenty of risks there. But I would only have a small underweight. I mean, if I had that at all, and I would, I'd use that to fund a bigger weight in international equities or in alternatives. I would not use that to fund a bigger overweight in mega cap equities because, frankly, people already overweight that. One of the things that I'm very worried about is that investors kind of passively sit back and say, "Well, I didn't do anything to my portfolio. The dividends went back into the stocks, and the coupons went back into the bonds." But we checked out a portfolio. If you had a portfolio that was 60/40 back in the start of 2019 and you didn't rebalance and you let the dividends flow back to the stocks and the coupons flow back to the bonds, you don't have a 60/40 portfolio anymore. You've got a 74/26 portfolio. So over time, as these portfolios have grown, they become more risky. And so I think people need to just, every statement says what your returns are. None of them say what the risk is. And I think people just need to think about where they are in life and what's an appropriately balanced portfolio for where they are in life. And that means having everything on the plate.
Absolutely fascinating, David. Well, I will bring that to a close here because you've been very good with your time. I've been thinking ever since you said about the tortoise and the hare analogy. Who was it that won the race? It was the tortoise in the end because slow and steady
Yeah.
wins the race.
Yeah.
I think we're all who are we racing against? I suppose as investors, ourselves ultimately, and I suppose against our investment objectives, not necessarily against a neighbor. So it's been fascinating to hear and get an updated view of your views on all of these topics we've cycled through. Thank you so much for coming here and sharing your insights with us.
Anytime, Ethan.